Hey everybody, it's Chicago Sean, and I want to share a thought experiment I have for buyers of long options, whether you're buying calls or you're buying puts. One thing I talk a lot about is the math, quote unquote. We want the math to work in our trading. Something that is obvious to most but bears constant repeating is that it's much easier to be successful when our winning trades are longer or larger than our losing trades. When that happens, we can have a low batting average but still win games. With this in mind, I know there are a lot of you who are hearing these messages or engaging with me online who only prefer to play naked long options. Meaning you're bullish. When you're bullish, you just want to buy calls, and when you're bearish, you just want to buy puts. Maybe that suits your temperament best. Or maybe you have brokerage account restrictions based on the type of account you have, which doesn't let you trade options or trade spreads or short options. The reasons don't matter. If you're one of these people, I have good news for you. It's pretty straightforward on how we can make the maths work with straight long options. So think about experimenting with this. When we own long options, as long as they are winning, keep holding them all the way until expiration. Doesn't matter what duration you have in these options, whether you bought them with a week out or a month out or 6 months out, just hold them all the way into expiration. Why? Because these options have theoretically unlimited upside participation. Easier said than done, of course, as every bone in our body will want to sell when we're sitting on a 20-point winner. But the only way to ride a 100-point winner is to hold when you're up 20, up 30, up 40, etc. On the flip side, if we're holding long options that are currently losing, let's just close them. Long options are decaying assets, and if the price isn't going our way, we'll be swimming upstream against both price action and theta or time decay. So just do a sweep through your account once per day and simply eliminate the losing options. What does this do? After a series of 100 such trades, it's likely we'll have as many as 70 small losers. But stick with me here. We'll also likely end up with 20 small to medium-sized winners. And then we might have as many as 10 big winners equal to 5x or more of our original investment. In the end, this math works for our account. Am I crazy? Do you do something like this? Let me know. I'd love to hear from you. I'm Chicago Sean. I'm the Chief Options Strategist at All Star Charts.